Chakri, I know you couldn't join us and come into the office today. It's obviously a fairly busy day for you. You are at your trading desk at the moment. So I'm guessing you guys are now shifting out of risk mitigation. Tell us, what are you looking to buy today?
Good morning. Thank you. Yes, indeed, it's a busy day today. And, India got stuck in the volatility, the global volatility. But in India's case, the situation is more fundamental in the sense that earnings growth is looking to recover, inflation is picking up, and the latest government budget actually is going to kind of increase inflation because of a higher farm produce price that it will pay to the farmers in buying produce. So against this backdrop, RBI is going to come out with its policy. They expect no change in the interest rates, but we just hope that they don't sound hawkish, because at this point in time, what needs just to calm nerves rather than to talk up rates.
Yeah, I was about to say, when you look at the markets there in India, easily you have the most expensive market in the Asia Pacific, and hopefully this recent sell-off has taken some of the fat off. Do you think that's going to put a little bit more discipline in the frenzy that we have seen in that market, Chakri?
The Indian market has gone up alongside the other markets, and in fact it has underperformed emerging markets in the recent past. And, even after the correction yesterday, some of the mid-caps are looking far more palatable. But the bigger story is, in my opinion, is earnings growth. These stocks are looking expensive because of lack of earnings growth for the last several years, and the hope and expectation that it will start picking up in the coming quarters.
Chakri, we saw the Indian stocks drop 5% over 6 sessions. How do you assess the contagion risk for the Indian market in particular?
The Indian market basically needs to raise capital because corporate India's balance sheets are leveraged. The overall debt equity ratio is 1:1, which means there is a need for a lot of capital raising in the form of primary offerings. So against this backdrop, you need conducive equity markets. So this is like a chicken and egg story. Now, if equity markets fall, primary issuances fall, that again delays capital raising plans. So what is the need of the hour is an accelerated capital raising plans, but the LTCG is a dampener from that perspective.